Hey everybody, JJ here. Welcome back for another Wednesday of Zoom networking. Got an unbelievably awesome young man coming on today as our guest speaker. Just a heck of a nice guy. I always talk about real estate, our wealth, or really the relationships, the friendships we make, and the people that we come to know, like, and trust. And I've had a chance and pleasure to meet this guy on a couple of occasions. He is my good friend, Mr. Nic McGrue. Nic, how are you?
I'm doing well, JJ. Thanks for having me.
Oh, it's a pleasure, brother. You got the $1 million smile there, man.
Thank you.
We're going to get into your topic today, and the topic is going to be raising capital for real estate projects. But before we go there, I wanted to talk about you just for a minute. Where in the country are you located, for those that don't know you?
I'm in the wonderful city of Inglewood, California.
There you go, home of the fabulous Forum and the Lakers, and
Yep.
Good, big part of my growing up. So real estate, we're talking, it's a real estate industry, but we're talking about, raising capital for real estate projects. So when it comes to real estate, I wanted to ask, is this something that you were around as you were growing up? Maybe, when we're driving and voting in our teens, we're becoming young adults. Was that something that was on the horizon for you? Was mom an agent? Was dad a contractor? Were you remotely around it? Or is it something that came maybe later on in life for you?
It was primarily something that came later on in life. I do remember I was probably like 10 years old, maybe 12. And at one point, my dad and my two uncles actually were talking about being a developer. They're like, let's buy a piece of land. And they knew some building design. It's kind of like a modular home, and talked about it, but just never really got there. And so one of the things that always, or as I've gotten older, one of the things that made me think of is how blessed we are to be in this age, because I think what they were missing is kind of what you're talking about, the network and the knowledge. And so they were like kind of there, but couldn't really pull the trigger. But yeah, so that was when I kind of slightly got exposed to it, but it wasn't very long lived. It was more so when I got older and started thinking about, I don't want to be working and grinding forever, and what are some ways to get out of that. And real estate was the answer through all my reading, posts, etc. That's one of the answers that was common that I saw. And so that's kind of what pushed me towards moving and staying in the real estate industry.
Well, and those that don't know you would be enlightened to understand that you're also an attorney, or a real estate attorney. Is that correct?
That is correct. Yes, at Polymath Legal, we help real estate investors lawfully raise capital so that they can generate passive income while creating generational wealth.
Great. And so you've been doing that for how long now?
I've been an attorney since I was licensed in 2009, and I've had Polymath Legal since about the end of 2010. And we started out focusing primarily with real estate. And now we still do a whole lot of real estate, but securities, the raising the capital for real estate, that's a big portion of what we do now.
Great. Now, getting into this, becoming a lawyer, getting into raising capital, was this something did you go to school to become an attorney after high school? Did you go to college and then study law? Was that your path to becoming an attorney, or was it?
It was. Yeah, it's a kind of an interesting path, not a crazy path, but the thought of being an attorney first got in my mind when I was in 9th grade. There was a show called The Practice, and it was actually about criminal law, but I liked watching it a lot. And I remember my dad said, you could be a lawyer if you wanted to. And I was always a pretty good student, but I thought like lawyers are like the super, super smart ones. Spoiler alert, I know many lawyers and they're not all super smart. Many of them are not smart at all. But I thought many of them, I was like, my dad said that, and I was like, oh no, you got to be really smart for that. And he was like, no, you can do that. And so that was like the little seed that was planted. And then when I got to college, I'm originally from Washington State. So I went to the University of Washington, and I got an email, and it basically said, hey, would you like to be on the listserv for potential law students? And they're like, we're going to have, guest speakers and tour the law school and stuff like that. And I figured, more information, what can it hurt? It's an email, I can delete it if I don't want it. And so I signed up. And I went to some of those events, and I was like, oh, this seems kind of cool, kind of interesting, but hadn't really thought that was what I wanted to do yet. And then my sophomore year, I had to take an introduction to business law class. And I just loved that class. It just clicked with me. It made sense. I'm very much like a order and a rule follower, and law has like a process and systems. And so it just kind of works with how I think. And so that's what made me want to go to law school. And I really like logic as well. And the law is very, very logical. And so taking that class, I was like, yeah, you know what? Law school is happening after this. So graduated from University of Washington like June 15. And then I had my little two-door Saturn packed with every belonging I had, driving down here August 1st to start law school after that. So like a month and a half after I graduated.
Good for you. Good for you. So let's jump into your topic today is, raising capital for real estate projects. You've now been focusing on raising capital for how many years now?
We've been probably assisting clients maybe since I've done it since 2012, but I'd say heavily since 2016. It's become, now it's like 60 or 70% of what we do, and has been that way since about 2016, 2017.
So now, as we talk on this topic, is this something where real estate investors would engage the service of an attorney like yourself? What do they need to look out for? What are some of the things that would escalate or speeden up their path to raising money, and what might be some of the things that they want to be careful of, or how do you want to start delving into the topic? Because it sounds like there's a lot here.
Yeah, we'll get into some things, but we could talk on this for days. I'd say one big thing that a lot of people misconstrue is they either don't know what a security is or don't realize that they're selling a security. And a lot of securities laws is very complex. It's very nuanced. It's very case by case. And a lot of people get annoyed when lawyers say it depends. And I get the annoyance, but that really is the answer, because it really does depend on the specific facts. But with securities, they've done a moderately good, giving us some bright lines to understand whether we're selling one or not. And so the kind of cliff notes of whether you're selling a security or not, and this is not a be all end all, but if you ever have a passive investor, your red flag should be going off saying either this is a security or it might be a security. Let me look into this more. More aptly, one of the big tests that we use is called the Howey test. And it says that we have an investment of money into a common enterprise with an expectation of profit primarily from the work of someone else. So investment of money into a common enterprise, expectation of profit, primarily from the work of someone else. So if we fit all four of those categories, then it's likely that we're selling a security. And so the law says that we're selling a security, then you either have to register that security or have an exemption. But a lot of people will say, and I actually talked about this very recently, a lot of people will say, oh, it's not a security, I'm just getting some money, or it's debt, so it's not a security. And if you notice, when I discuss kind of that test there, it doesn't talk about debt or equity. It just says an investment of money into a common enterprise with an expectation of profit primarily from the work of someone else. So if we fit that, then it's likely that we are selling ourselves a security. And so now we've got to start navigating the securities regulations. And so I'd say that's probably one of the big mistakes, for lack of a better word, that people often make, is that they, might be violating securities regulations, but they don't even realize it. It's not purposeful or it's not malicious, but nonetheless, that lack of knowledge or understanding in what they're doing makes it to where now they're doing something that if things go bad, they're going to have a lot of issues because they're probably not complying with the regulations there.
So I guess being a newer investor, I hear people talking about buying a smaller house, buying a smaller project. They're talking about $100,000, maybe $200,000. Now, when you're talking about raising money for real estate projects, you're almost getting into millions of dollars, right? Not just hundreds of thousands of dollars. Is that correct?
That's typically what we're working with, but the dollar amount doesn't affect necessarily whether it's a security or not. So $100,000 could also be a security. Okay. Now, with that, there, as I mentioned, so if you are selling a security, it doesn't mean, oh, you can't do it. It just means now we got to know which laws we have to navigate and comply with them. And so if we're selling a security, one way to comply with the law is to register that security. Now, I'll tell you, in real estate, at least with my clients, we're dealing with retail investors versus, institutions. registration is not going to make a lot of sense. One, it takes a whole lot of time. And so if you got a deal you're trying to raise this capital for, you're not going to have the time to register and then raise the capital. Also, it's very expensive, where you might be looking at 100, 200 more or $1,000 or more to register. And so for my clients, that's just not what we do. So you have to register, or your other option is to find an exemption. And that's where we come in. We find the exemptions where it says, hey, you're selling a security, but let's follow a different set of rules so that we don't have to register. And so if we follow that different set of rules, then we have an exemption that says, if you follow these rules, then you don't have to follow those rules. But you're still compliant.
So now let's follow the path of the exemption. If we have an exemption, is this where it breaks down into, I'm thinking two things. One, does the dollar amount matter, the actual dollar amount of what's being raised, as well as, or versus whether we know the people or not?
Okay, so I'll address the first one first. The dollar amount from a legal perspective doesn't matter. Now, from a practical perspective, if you have a low dollar amount, you're still selling a security, but it might not make a lot of sense for you to do that. Because if you're doing an exemption, you're likely going to need to have an attorney, which costs money. You're probably going to create an entity and have some other costs. And so while you are raising money, there are costs to that money that you're raising. And so you wouldn't want to, let's say that, setting up let's say that it costs you $15,000 to set up your security structure. It's not going to make a lot of sense to spend $15,000 to raise $100,000, because that's 15% of your money gone right there. So if you're wanting to give somebody a 10% return, you're actually having to get a 25% return. And so that's what I meant when I said while there's no legal limit or legal minimum or anything to the amount that you can or need to raise. From a practical viewpoint, there is a limit that you probably want to look at, because you want to make sure the costs that you're incurring make sense with the amount of money that you're raising.
I hear people talking about, as new investors are moving forward, is that, okay, we'll find a property, we need to find a private money lender. So we go to find a private money lender, and we need to have some sort of an agreement with that private money lender. Certain education platforms have their standard documents, but do you recommend that people engage it? I mean, it seems to me, from everything I'm being told as well, it makes sense to talk to an attorney and make sure someone reviews our paperwork and make sure things look good. Do you recommend that when people are engaging with a private money lender, that they have some sort of counsel that might review something, or what's your take on that?
Yeah, at the very least, you're going to at least talk with an attorney and say, hey, here's what I'm planning to do. What should I be looking at? What should I be looking out for? And we do that with clients. Sometimes we'll set up a system and say, yeah, you'll pay us and we'll do a consultation. We'll draft the documents. And then I'll say, look, when you have a new thing, we probably can reuse these. Let's talk. Let me know in case there's some nuance that changes it. But the likelihood is that it might work and be the same. And so you're not necessarily having to, redo everything every time, but it's still good to make sure you're talking with somebody who's experienced and knowledgeable, so they can look at your unique situation and say, yes, what you're doing right now still works and accomplishes your goals while complying with the regulations you need to follow.
Now, do you see a standard type of question or standard types of deals, or is there a vast difference of the things that come through your door?
We have probably a handful of different scenarios we're used to, and we're expanding more because prior to maybe a year and a half, 2 years ago, in their capital raising realm, we primarily work with multifamily. So you're talking larger numbers, larger amounts of investors, and also larger checks. But now we're starting to get a lot of clients, as you were talking about, that having private money lenders. So maybe one check writer, maybe two, and for smaller dollar amounts, $100,000, $50,000. And so we're seeing some differences there and getting expansion in that area, which is it's welcomed and happy.
Okay. I hear on occasion people mention things like having a fund, they're building a fund, they're putting a fund together. When we start hearing these things and people are mentioning this to us, asking us to contribute to a fund, what might be something we might need to look at to know that we're dealing with someone that they're crossing their T's and dotting their I's? Do they need to tell us that they do have an attorney? They don't have. Oh, we don't need an attorney. We're just creating a fund. What is something that a new investor might want to look out for, be aware of when this topic comes up?
Thank you for that. Yes, because I see this done incorrectly. And thankfully, I have some clients that'll come and say, hey, I'm thinking about this investment. Can you look at their documents? Let me know what's going on. So a couple of things. One, I'd say if they don't understand that they are selling security, so the person you're going to invest in, if they don't understand that they are selling a security, then it's likely that they're not complying with the laws required around selling security. And while that's not going to directly affect you because you're not the one selling the security, so you're not going to have the issues, but they are the ones that are operating your deal. And so if they're having to deal with a securities investigation, that's going to be time and probably money that's spent dealing with that instead of making sure that your investment is growing. And so while even though it's not your duty to make sure that they're following all the rules and stuff, if they're not, it is going to indirectly affect you. Some other things that I would look at is if they're selling a security, particularly if we're talking about to a large group. Now, if you're talking about a single private money lender, there's other exemptions to where this may not be as necessary. But typically, there's going to be a lot of disclosures that are necessary when you're selling a security. Because let's say that I'm the issuer, I'm the one selling it. I know the good parts of this deal. I know the bad parts of this deal. You, because it's not a public company, you don't know the hidden secrets. And so my duty as the one who knows all that stuff is I've got to disclose that information to you. And so there's a base level of information that the SEC requires that you disclose so that you as an investor can determine, does this make sense for me or not? And so some of that is, what's the business plan? What are we actually trying to accomplish here? How are we going to use this money? What are the proceeds used for? What are executive salaries? What is the executive compensation? Are there fees that are taken out? Because some investments you might have, and this is common, so don't think that it's wrong or necessarily wrong, but you might have an acquisition fee, a financing fee, a management fee, and some other fees, and those fees are treated as expenses. And so a lot of times when you're dealing with an investment, you might, as an investor, get something that's called a preferred return, meaning that you're going to get a certain amount of money before the operator, the owner, the issuer, before they can even partake. And that's there to incentivize them. And so a common one is I might get a 6% preferred return, and then we start splitting the proceeds. And so what that means is that the owner has to give me a 6% return each year before they get to partake in anything. But if we look at the compensation, fees are considered an expense. And so fees actually come out before preferred returns are paid because that's just a company expense. And so prefs are paid after expenses. And so with that, as an investor, you want to know what fees they're taking because even though you have a preferred return, they're still going to be getting money before you do. And so at the very least, they need to tell you what is that money that they're going to get. Another big thing that they should have is risk factors. If I see it, if I have a client that's thinking about an investment and I see, a disclosure document to where everything is looking like roses and it's going to be perfect and beautiful and wonderful and we're all going to make money and nothing's going to go wrong, I tell them, run. That just doesn't happen. Or at the very least, you can't know that that's going to happen. All investments have risks. And so it's a duty of the issuer to disclose those risks and explain what those risks are going to be. Because again, they're in a better position to know the ins and outs, the good and bad of what's going on. And so they got to tell you that. They might need to say, look, we are going to need to refinance in year 5. And in the current market, interest rates are higher than they were 2 or 3 years ago. And if interest rates go higher again, that's going to make that refinance very expensive and change our returns. Or look, we're doing Airbnbs. And right now they're lawful in the city that I'm at, but there's an active community that's trying to fight against it. And so if they get their way and they're able to influence the politics in my local area where this asset is, then this Airbnb business model might have to turn into a midterm or a long or traditional term rental. And that's a risk because that's going to dramatically change our cash flow and our income and stuff like that. And so me as the operator, I've got to let you know that. And so when I'm dealing with clients that are the ones selling the security, one of the questions that I ask them is I say, what are the things that keep you up at night? What are you afraid of? What are you scared about? What are the concerns that you're like, I don't know about this? Because those are the things I say, look, we've got to tell them about that. And again, no deal's perfect. So when I'm reviewing it for clients, like I said, if I see one where they're like, oh, it's all going to be great, it's going to be perfect, I say run. Whereas if I see one where they're like, the world's going to end, you can lose all your money, these things could go horribly bad, but give us your money anyway. Those ones I say, look, at least they're being forthcoming. They are doing their homework. They know that things aren't perfect. They know that things can go wrong. And if they've thought about those things that could go wrong, they probably have some potential plans in place. And so those ones, again, I don't even know if it's going to go right, but those ones I at least think this is a more of the type of investment that at least I would invest in, because I know they're being straightforward with me, transparent. They know that there's a big burden that they're taking on, and they understand the risk with that, and they're telling me those risks so that we're being open and clear and transparent. And that's somebody who I'm going to be a little bit more trustful in giving them my money to hopefully make a return with.
Stacy Mertis, you are on with Nic McGrue. What's your question?
When we're talking about raising capital from PMLs, are we talking PMLs or PMPs that you're talking about that are getting a rate of return? Because usually you're just getting an interest rate, right?
Part of that just depends on the structure. But when you say PMP, are you saying private money partner?
Yeah.
So that if they're a partner, then you're typically not going to be selling a security because a partner is going to be active in the deal. And that's, and like I said, passive, while it's not the be all end all, if they're active, then it's likely that you're not selling a security. So with them, it's kind of whatever you guys have agreed to split up the proceeds, however that is. If we're talking about a private money lender, then again, it's just going to depend on what your terms are. But typically, if it's a lender, then that means they're taking a debt position, which means that you have an interest rate that you told them you're going to give them, and that's what you need to give them.
Oh, okay. Okay. And then what is the typical paperwork that's associated with that? Is that something Sub 2 provides? Do you know?
I don't know if I'm not going to say Sub 2 doesn't. I just generally don't know if they do. Okay. Again, and I hate to give the lawyer answer. It depends. It does depend on your structure, but some common ones that you will likely have is you'll have a promissory note, and then you might also have a loan agreement as well that kind of dives more into the specifics. The loan agreement, that's the actual contract. The promissory note, that's just evidence of debt. And so a lot of times with a promissory note, that if you're going to have the ability to do so, to put a lien on a property, the promissory note is what does that. You typically are not going to be able to put a contract on the property, but a promissory note can be liened on a property in most cases.
Okay. And that is that put together by the transaction coordinator or just between you and the PML or title?
I don't know that the transaction coordinator or title does that. They might have templates available, and I'll give the caveat. I'm a lawyer, so I'm always going to say call a lawyer, of course. Right. And there are times where I'll say you maybe don't need one, but most of the time I will. So yeah, for me, in my mindset, I'm thinking have a lawyer do it. And here's one of those examples though. Have a lawyer do it once, talk with them, get your questions answered. And if you're doing the same exact deal every time, that same documentation could probably work for each one. Again, it really depends on the structure and what's going on. But I often say at least have the lawyer do the initial one and get your questions answered. And they'll set up at least a base structure to where it probably works for 80% of the time. And you might have some weird ones that are a little off and it's not quite there, but it might be able to satisfy most of what you need usually.
Okay. Thanks, Nic.
Yeah, Nic, if I want to follow up on that, if I may for a second. The Sub 2 community, people are very familiar with that these days. It's a very popular program. Pace Morby is a very popular person. Not everyone is in Sub 2, as we know. They have a term there for transaction coordinator for someone who handles paperwork. Well, if someone's not in a program like that and they just find a project, they find a private money lender, probably be best if they don't have access to an education platform that has documents in their library. It's probably best that one have some sort of relationship with a real estate attorney that they could confer to. And then ideally, in a world where the education platform doesn't exist, that attorney would assist them with the paperwork. Yep,
exactly. Yeah, even if it's just saying, hey, here's what I'm planning to do, kind of like what Stacy did. Even if it's what documentation do I need? versus, Google has stuff and it sometimes is okay, oftentimes might not be. If you're in this and you're investing, invest in the investment itself as well, at least initially, to get the base level stuff. And, if you're trying to DIY it, at least have an expert kind of lead you at the beginning so that you're not going right when you should have been going left and now you're just way off.
It seems to me that when I was starting 5 years ago with another education program, learning about the nuances of how do you wholesale, how do you rehab, and in retrospect, they didn't really put a lot of emphasis on having. Well, they did say you have a team, you have a contractor on your team, you have an attorney on your team, you have a designer, different types of professions. Every profession thinks they're important, but I don't think it's properly emphasized the importance of having an attorney on your team. And you and I have been on a couple occasions, and that I like to I like to get to know the people I'm working with. I like to get to know that I like them. We have something in common. Oh my gosh, I love this person. Bring your family to my house. It's Christmas. Let's have, cake and food and whatever else. But I actually believe, it's important to build those relationships. And it's probably very, very important for even the beginning investor to seek out, whether through their network or just family, whatever, but to, in the beginning, even start to develop a rapport with an attorney. Would you not think that'd be a good move?
Absolutely. As you mentioned, it's, real estate is about teamwork, and, and just really any business, relationships. That's one of the many reasons I connected with you. But I was like, yeah, he's a relationship guy, which I am as well. That's actually even our firm's motto is relationships first. Because if I look at any of the successes I've had in my life, a lot of it either was a catalyst from a relationship or was able to pushed over because of relationship. And so relationships really do take you so much further. And so a relationship with an attorney also helps with that. Because I have many clients that we've been working together. I kind of know their flow. And so sometimes it'll be, I was working for another client and an issue came up, I might reach out to that past client and say, hey, watch out for this, or we should change your documents because here's what I saw. And it's because I have a relationship with them and I know what they're doing, know what their goals are, know how they're moving, and I can kind of be proactive versus them reaching out to me and they might not know exactly when to reach out to me. Whereas because we have that relationship and I know them and their business, I'm thinking about them and how we can help them, even when we're off the clock, even if it's not something that I'm making money off of. I'm a believer of my client's success is my success. And so I want to make sure that I'm setting them up for success.
Yeah, I think that's so very important. And again, as you said, we both have the commonality of the importance of the relationship. And for me, it's surrounding myself with good people. And I know that one of those 5 people, guys, we surround yourself with successful people, one of them better be an attorney. Scott Mednick, you are on with Nic McGrue. What's your question?
Cool. I'm curious, as I've heard different securities attorney answer this differently. Let's just say I set up a 506C. I'm buying the self-storage property for $5 million, need to raise $2 million. I have all these people coming in and saying, hey, I can raise 100,000, 200,000, 500,000 for you. And they want a percentage of the money. I know you cannot do that unless they're part of the GP. What are your workarounds on that as far as compensating people for introductions? Is it like a marketing fee, or what's your thought?
Yeah, the SEC calls that a finder's fee. And I will tell you that the workaround I have is not good because it's the laws as they are kind of just stink. I think the laws are written for a different scenario, usually more like institutional type stuff and not more the retail stuff. And so sometimes it doesn't make a lot of sense. So the SEC does allow finder's fees. Well, actually, I'll even take one step back. One is that if they're a licensed broker dealer, then you can straight pay them a commission, and that's perfectly fine. Most, when we're dealing with this, are not, though. So if they're not a licensed broker dealer, You can have a finder's fee, but a finder's fee, you are paying them solely for the introduction and finding a potential investor. You're not paying them because the person made an investment, or you're not paying them more money based upon the amount that they invested in. That's the only way to do a lawful finder's fee. And so that's why I said that kind of stinks, because if you're the one that's paying that finder, let's say that I say, hey, Scott, I can bring you a whole bunch of people, pay me $2,000 per introduction. And so let's say I introduce you to 10 people, you pay me $20,000, and 0 of those 10 people invest with you. You still have to pay me that $20,000 according to the SEC. Otherwise, it's an unlawful finder's fee. So that kind of stinks for you. So that's why I said the law kind of stinks. The few times that I have done this with clients after talking them through and not scaring them away from it, some ways that we do it is we'll do it not per investor, but just by time. So on a monthly basis, if they say, look, I know a lot of people, I'll invest, or I'll introduce people to you. And so we might say, look, we'll pay you $10,000 a month and you introduce us to however many people. And we're paying you that monthly for the introductions. And some might invest, some might not invest, and we can go forward that way. So yeah, I've done it monthly. I have done it per investor. The few that I did it with that were doing it per investor switched to the monthly. And then some of them have also just said, yeah, this is just not working. And that's what I think for many situations, the conclusion will be with the current state of the laws, unfortunately. I used to be hopeful that it was going to change, because about a year and a half ago, 2 years ago, they had a proposal that basically would allow you to get a commission, which is what everybody wants to do. You just had to have certain disclosures and things like that. But that was a proposed rule, like I said, a year and a half, 2 years ago, and I haven't seen any movement in it becoming an actual rule. So I'm still keeping my fingers crossed a little bit, but my hope is dwindling day by day, because it's been quite a while with no traction on that.
Right. But I know you can bring them in as a co-GP, but then they also have to have I think they have to be active in the GP, right?
Yeah, so a GP, a general partner, someone on the management team can, raise capital. But the issue that I see with a lot of people, and again, nothing has happened yet just because it hasn't been discovered, but I think if it were discovered, there'd be issues. Well, I've seen deals where there's like 50 GPs. I've had clients that are doing, $200-300 million development deals, ground up development, and they don't have 50 people on their GP team. And so if I see 50 people on and this is not, disparaging to anything, but 50 people on a 50 unit apartment complex, you don't need that many GPs to do that. And so if the SEC ever saw that, my guess is that they'd say, yeah, you're not really a GP, you're a capital raiser, and you were getting paid for raising capital, and that's a problem. And then I've also seen some where they're like, yes, you're part of my GP team, and maybe there's only 10, which still might be a little bit much. But they say, look, you've got to have this active role, and this is your responsibility, and this is what you're doing. But then they also say, we're going to give you X percentage for every $100,000 you bring in. That still would also be problematic as well, because we can compensate you as a manager, but we can't specifically give you a commission, a percentage of the capital that's being raised.
All right. Thank you. Appreciate it.
Yeah, that's an area where I think the law is deficient. I get what they're trying to do, but I think it's deficient for the state of what a lot of people are trying to accomplish now. At some point, it probably made a lot of sense, but I see a lot of areas where it doesn't make much sense right now at all.
If we want to go raise money, let's say we have a project, someone brings us something, we find something, it's in the, let's say, $2 to $5 million range, and we need to get money. It's probably best to see you first and get a game plan for how we're going to approach people. Say someone like myself, I know a whole lot of people. Do I start reaching out but hey, I need money, or do I turn around first and say, hey, Nick, let's put a plan together about how we're going to go about funding this thing?
Yeah, I'd say talk with the securities attorney first to see what are your options. And you're going to want to tell them, here's what my goals are. Here's how much money I'm trying to raise. Here's what my investors look like. And then they can walk you through, okay, so you are selling a security, or maybe you're not selling security. But if you are, they can say, okay, you're selling a security. Based upon what you've told me, here's a couple of exemptions that could work for you. But what I know based upon your goals, here's one or two, or maybe just one that I think is good for you. And here's the rules that we have to follow. The reason that I think it's very important to make sure that you have that plan in place first is because you can take certain actions that to where you might have qualified for certain exemptions, but if you do certain things, you're taking those exemptions away. And if you needed to use that exemption, you now have made it to where you can't do that. And primarily, I'm talking about with advertising. Some exemptions don't allow you to do what we call general solicitation. So going on Facebook or messaging in JJ's group or something like that. Some won't allow you to do that. So if you do that and then you meet with an attorney and you're like, oh yeah, I want to do this exemption. And the attorney says, hey, for this exemption, advertising isn't allowed. And you say, okay, I understand. That's cool. I only posted it in my Facebook group. They're probably going to say, yeah, we can't use that exemption now because you've already advertised. And so we've got to use an exemption that allows advertising. So that's why it would be important to strategize beforehand so that you don't pigeonhole yourself into something that may not have been the best plan for you.
And are there two different types of generic or general exemptions where one allows for advertising, one doesn't? I think Scott had mentioned one of the exemptions earlier, one of the ways to go about gathering funding.
Yeah, so there's lots of exemptions. The two that work really well in real estate, they fall under what's called Regulation D, and it's 506B as in boy, 506C as in cat. So he was mentioning 506C. That allows you to have an unlimited number of investors. You can raise an unlimited amount of capital, and you can advertise. But every single one of your investors must be accredited. So there's lots of ways to be accredited, but the two common ways are income or net worth. And so we're talking about an individual. We're saying that your income has been $200,000 or more for the past 2 years and will be that much or more this year. Or your net worth is over $1 million, excluding your primary home. So you're either a high income earner or you have a high net worth, and that's how you're accredited. And so if you're the issuer, the one that's selling the security, and you know that the people that you're targeting are all accredited, then 506C might work very well for you because you can get all of the accredited people that are in your network. Plus, if they've got friends or their friends have friends, as long as they're accredited, they can hop on board and invest as well. We contrast that with 506B, B as in boy. That one allows you to have an unlimited number of accredited investors. You can also have up to 35 unaccredited but sophisticated investors. Sophisticated is not very clearly defined, but essentially it means they're financially savvy. So either based upon their education, their work history, their investment, current or past investments, or using a financial planner, we can say, look, they know how to determine the risks and merits of this deal and this investment based upon their financial profile. So that's what sophisticated is. So again, 506B, you can have an unlimited number of accredited investors, up to 35 sophisticated investors, but the catch is you must have a pre-existing substantial relationship with all of the investors. And so that's essentially what I was getting at, to where if you're trying to do or thinking you want to do a 506B and you go post that deal in a Facebook group, you now can't do a 506B because you've been soliciting that deal.
Okay, now let's say, for example, somebody wants to do Facebook. They don't want to solicit a particular deal. They've got, they belong to a group of 5,000, 10, 20,000 investors, and they have people on their friends list because this is Facebook and we're using this Facebook community or Instagram. How do we decide where we are from somebody we actually know and someone just being on our friends list?
Wonderful question. Yeah. So with sophisticated or with the 506B, we say it has to be a pre-existing, meaning that you knew them before the deal was in place, and then a substantial relationship. So not just that you knew them, but it's got to be substantial. And essentially, one way to show that it's a substantial relationship is that you understand whether they're accredited or sophisticated and the reasons why. So you understand about their investment history and their financial background and their risk tolerance and that sort of stuff. So it's more than just you're on my friends list, or I met you in a Facebook group, or even we might have met in person at a meetup and just talked. It's you've got to know a little bit more about their finances and their financial position and things like that.
So I'm making a little note here on our post in the group about accredited or sophisticated investors. And so that's something that's important for us as new investors to know, because as we go to acquire funds and network and gather people to invest with us, that we need to understand the difference between an accredited and a sophisticated investor.
Yeah. And with securities, like I said, there's numerous exemptions. So we were talking about Regulation D, and 506B and 506C are underneath that. And that works very well for real estate. But there's other ones. Let's say you're like, look, I don't want to be limited to just accredited investors. I don't want to register, but I want to be able to advertise. You got other options, Regulation CF or Regulation Crowdfund. That allows you to advertise. Anybody can invest. The only thing is that if they're not accredited, then they might be limited as to how much they can invest. So that, again, is why I'd say talk with an experienced securities attorney beforehand so you can strategize and they can understand, what are you trying to accomplish here? We've got a couple of different ways we can do this. Let's see which one is going to make the most sense for you. Reg CF is not without its own potential issues. Typically, Reg CF is going to take a bit longer to launch. You also are limited with Reg CF to a maximum of $5 million per 12-month period. So it's not unlimited like Regulation D is. And then another thing that you have with Reg CF is that your offering must be hosted on an SEC-approved platform. Now, with a lot of syndications and funds, people are moving towards platforms. Essentially, what these are is that if you're an investor, you can log in and you can get your tax documents. You can, see the distributions you've gotten. Kind of like if you're to log into, I use Charles Schwab or whatever brokerage account, you kind of see your positions. So that's what a platform is. And I'd say probably in the last 3 years or so, a lot of people are moving towards that. It just gets a more refined look for your investors and things like that. But you are not legally required to do that with a Regulation D offering. With a Reg CF, there are specific platforms. There's about 45 of them that are registered or approved. And with Reg CF, you are required to use one of those platforms. And so the reason that I said that Reg CF is not without its issues is because those platforms have an expense. Usually they'll have, a couple $1,000s up front, but then they also will often have a success fee, meaning that they're going to take a percentage of your deal. So I've seen some as high as a 7% of the amount raised. So again, if you're going to do that, it could be worth it for you, but just know you're going to have at least 7% of expenses gone. And so you want to make sure that you accounted for that. So Reg CF is another option you have that could be beneficial depending on what your exact goals are.
And when you talk about these platforms, and you had mentioned Charles Schwab, Fidelity, there's a variety of them. Are these the names which represent the platforms you're referring to?
No. Those platforms, they're their own brokerages. These are like, you and I could create a Reg CF platform if we wanted to. It's a process. So we'd have to have a tech vendor that's going to, do the technology to make it work. And then the SEC is going to, review us and vet us because we're holding people's funds and also educating investors. So it's not Charles Schwab or anything like that.
But it's we'll have a web page for our fund or is it a fund if we do this, or is it not a fund if we do this?
It's technically a fund, yes, it's a fund because the timing that you need with Reg CF, typically you're not raising for one asset. Occasionally you are, but it's set up to where you could have multiple assets within it. So it is technically a fund.
So we create a platform, we have some technical people create basically a site, right? That people can log into and check what we're doing.
Kind of, except I was saying that you and I could create it, meaning that it doesn't have to be Schwab or anybody. Yes. But if you and I were the ones raising capital, we wouldn't create the platform. We would just go to one of the already created approved platforms and host our deal there, most likely.
Got it. Like a web host carrier or something.
Essentially, yeah. Yeah, and so the platform will probably list our deal and any other deals that are on the platform as well. So if anybody goes to that website, they can click on our deal, they can click on other people's deals, and if they want to invest, then they can click through and fill out the paperwork and do all that's necessary to make that investment.
Great. This is all new stuff for me. Glad to know. And
good.
I'm gonna have to follow up with Nic here because as one builds relationships, as I say, networking leads to visibility, visibility to opportunity.
Mm-hmm.
network, the more we market ourselves, the more people are aware of who we are. That brings more opportunity. I've done a little marketing, I've done a little networking, I've created a little visibility. So I think it's probably time for me to come talk to you.
There we go. I like it.
What are some of the hurdles that you see, either yourself that you've experienced along the way, or maybe some common hurdles you see new investors experiencing that should have come to you first and didn't, and you see some of the pitfalls that they've had to overcome, that they are things that without your guidance become a problem, and with your guidance are things that you point out that people should be wary of?
Yeah, I think it's some of the things we've touched on. A big one is not knowing that you're selling a security in the first place. Because if you don't know you're selling a security, then you're not going to even be trying to comply with securities laws. So that's one. I'd say the next one is kind of what we were just discussing, not understand if you do know you're selling security, not knowing which exemption you're going to use and taking action before that. And sometimes that action will corner you to where you've taken some exemptions off the table that would have otherwise been available to you. I'd say another one, this is not one so much as a mistake, maybe a misunderstanding. At least I will say this for me, and I will say this for most of the securities attorneys that I know. You don't want us doing your underwriting or your financial analysis or things like that. Now, with that, I see a lot of deals, so I know this stuff a bit, and I can see if something's way out of the norm. But I'm not the one that's going to help you understand what your splits should be or what types of returns you should be giving, or even if this deal is going to pencil out in the first place. And I've had people that are new, and I get it. They're new. They're just like, I need help. You're somebody that can help. Do everything. And I'm like, no. I have a specific lane that I work in. But I've had people that are newer that say, hey, so yeah, what should my returns be? Or how do I know if this deal is going to work? And I say, that's something that you've got to figure out. That I'm here to make sure that you can reach your goals and follow the laws while doing that. But you're the one that sets out what the goals are. And you're the one that knows whether this is a worthy goal or whether it's a goal that you can attain or not. And so really knowing your numbers, knowing your deal, knowing your offering, that's something that you've got to come up with yourself, or at least you and your team need to figure out. And you don't want your attorney handling that in most cases.
Let me throw one word out that we haven't really touched on: syndication.
Mm-hmm.
I heard about funds. We talked about funds. We talked about gathering private money lenders. Where does the syndication fall in with all this? Is this a completely different beast? Is this something that's very similar? Or is putting a fund together the same thing as syndicating?
Yeah, so very, very much related. And so I'll give you the technical answer and then the industry answer. So technically, syndication is the umbrella term for all of it. Syndication means that we're pulling capital together, whether it's a fund, whether it's a one-off deal, we're pulling capital together, we're syndicating that finance or syndicating those funds. So definitely they're all related, but technically syndicating is the umbrella topic. Now in the industry, in the real estate industry, people more refer to syndication as a direct deal. We've identified the asset. We know exactly what we're investing in. And then when they're using the term fund, they're saying we don't have an identified asset. We maybe have an asset class or a market, but we don't know what it is. So an example, a syndication would be that I'm raising capital to buy 12345 Main Street. So we know what that asset is. We know what the deal is. We know where the money's going. A fund might say, I'm raising capital to buy value-add multifamilies in the Southwest markets. And so we don't know exactly what it is that I'm going to buy, but we know it's probably going to be value-add multifamily in the Southwest region. But we don't know which states or which cities or how big it's going to be necessarily, and definitely we don't know what that exact asset is. So that's kind of the difference between the two. In the industry terms, syndication is an identified deal, whereas a fund is we maybe identify the general type of deal, but not the exact deal itself.
If people want to reach out to you, what's the best way for them? Is it your MySpace, your TikTok?
I wonder what my MySpace looks like right now. I didn't delete that years ago, so it's still around there somewhere. The best place to find me, Instagram, it's at Nic the Lawyer. So that's Nic with no K. So it's at NIC the Lawyer. And on there's a link in the bio that takes you to the website, and you can it has our phone number on that link. It has the website has a way for you to schedule a discovery call to to kind of see how we might be able to help you. And then also you can email us directly through the website as well. So if you go to Instagram at Nic the Lawyer, that has all the links and all the different ways to contact me.
So my last question before we close off, I've got a networking group, and I'm always talking week after week about the importance of networking. I think I've become a talking head after a while about networking. But whether someone's a new investor or an experienced investor coming to the platform of social media for a real estate business, and every education platform has a Facebook page for its community. So we're all generating, we have one, we're making a new page, and new investors, experienced investors are coming to Facebook to partake in these education platforms. What's the importance of networking? Facebook and Instagram. In my particular case, I talk about Facebook all the time. But what's the importance of networking and possibly joining a network somewhat like mine? Because with Facebook, I can have a networking group. So again, the importance of networking as well as joining a group, in your opinion, as a seasoned, experienced attorney, real estate attorney, what is the importance of networking on those two realms?
It's the utmost important. If you're really trying to get into this and really play the game, then networking and joining these types of groups I think it's a must. And I think I've learned that as I've gotten older and had some forms of success. I used to think, oh, I can do this all myself and I'm going to figure it out and I'm going to grind it out. And that's a nice skill set to have, but you don't have to do that. I've started learning you want to, buy the shortcut or get the shortcut from people around you. Or at least I often hear, experience is what makes people, strong and good, et cetera. But you don't necessarily have to have that experience. Somebody who's been in an industry and gone through the ups and downs and has 10 years of war stories, having a conversation with them, you're going to learn a whole lot from them. And a lot of the stuff you're going to learn, you're going to avoid some of the learning lessons. I don't call them mistakes. So I think as long as you're learning, that's just part of the game in entrepreneurship. But you're going to take their lessons or their mistakes to where you essentially using their experience, but not having to go through the hardship that they had to go through to get that experience. And so I think that's the cheat code, essentially.
Yeah, I've used that phrase in the past as not having to reinvent the wheel.
Yep, exactly.
Well, Nic, I really want to thank you for being on today. We're going to go to the breakout room shortly. If you guys are on the call right now, don't go away. We're going to have some more of our more intimate conversation with Nic, with just us. If you guys are watching on YouTube right now, please like Nic's video. Please put some comments down in the YouTube area there for your feedback or your takeaways on today's presentation. We'd really appreciate, put some kind of comment in there and like the video. If you guys want to reach out to Nic, it is, again, at Nic the Lawyer on Instagram is his Instagram handle. If you guys want to connect with myself, my website, I'll share this for the first time. I don't think I've ever shared my website before. But this is my website, jjzizin.com for JJ's Mastermind Networking. I'd ask you to click the register now button, and that just allows you to register for the group itself. Please look for more videos coming up for me on my YouTube channel, Flip Set Up with JJ. Register for my group. Come join us. And if you guys are on the call right now, hang on. We're going to go to some breakout rooms. Nic, I guess we'll say goodbye to them, those that are watching on the YouTube world. And you and I will join everybody else. We're going to talk about the Chargers and some football.
Awesome. Thank you all.
All right, guys, thanks for joining us. Talk to you soon.